Risk management must be part of your core trading strategy. Protecting the money you made is the way to make consistent profit and ensure you have a long, successful trading career. In this video, we bring you 5 checks and balances to help you manage your risk. First is to consider your portfolio as a whole to ensure long-term survival. On the whole, individual stock selection doesn't really matter. What really matters, over the long term, is asset allocation decisions. It is not what stocks you buy. What matters is the timing of buying stocks versus buying bonds, gold, cash, and real estate. Asset allocation is far more important to your total portfolio return than stock picking. Second is to use stops to limit your losses. One of the easiest and most effective ways of protecting yourself against the risks of a volatile market is by using stop losses. When you know how to utilize them correctly based on the nature of the stock, commodity or index that you're trading with, you can protect yourself quite effectively against trades that lose money, rather than earn profit. Third is to take advantage of trailing stops to protect your profit. In addition to static stop losses, you can use trailing stops. For a long position, this is essentially a stop loss that follows the price of the asset as it moves up, but stays put if the asset price starts to go the other way, and vice versa for a short position. A trailing stop allows you to lock in profit as you make it, by protecting you against significant moves against your position. Lift the stop every time the stock hits a new high, in order to protect profits and ensure investors aren't riding a loser all the way down to the basement. Fourth is to size your positions correctly to optimize your risk level. Position sizing is a critical component of your risk management strategy. By using it correctly, you can avoid large drawdowns in your trading capital, while maintaining profit. The basic premise is that the size of your position should be proportional to the expected outcome. Fifth is to utilize covered calls to minimize downside risk. A simple way to reduce the risk of holding stocks and exchange-traded fund, while increasing cash flow at the same time, is to sell call options against your shares each week or month. It's called writing a covered call, where you own the underlying stock, but short sell call options against those shares. The negative is you put a cap on your upside, but in return you gain weekly or monthly income to protect part of any downside move. If you do this consistently over many months or years, you will achieve a higher risk-adjusted performance than buy and hold. The strategies we covered are all focused on protecting your portfolio against loss. They won't necessarily help you to improve your profit on a per-trade basis, but they will help your monthly and yearly total profit increase because the size of your losses will decrease. In summary, the major components of your risk management strategy should be: to stop losses, to correct position sizing, to optimize asset allocation. We will come back to you with a newer educational video very soon.